Reaching the point of trading consistency is the ultimate goal of every trader, and to achieve this milestone, you will need to incorporate 3 pillars into your trading, which will require finding the market direction, evaluating the strength of the trend, and effectively assessing the volatility. Most traders apply 3 or 4 indicators to get this information, but at the same time they clutter their charts. One viable solution to this problem is the Trader's Dynamic Index. In today's video, we'll discuss about the TDI indicator, and I will share how to correctly trade with it and how to incorporate it in a trading strategy. Trader's Dynamic Index is a hybrid indicator that can read the market sentiment, market volatility, and the momentum at the same time. The advantage of combining the qualities of several indicators into one indicator is what makes the TDI so special. The Trader's Dynamic Index is based on 3 other popular indicators: the RSI, moving average, and the Bollinger Bands. The standard RSI indicator determines the strength of the current trend, or if you want, the rate of change in price. The moving average algorithm is used to smooth the lines and to eliminate RSI false signals. And Bollinger Bands are used to estimate the amplitude of oscillations, meaning the volatility. Now let's break down the Trader's Dynamic Index. As you can see, the TDI has 5 lines. The green line represents the RSI indicator and represents the market sentiment. It shows you how the market is moving related to positive and negative expectations. The red line is simply a moving average of the green line, meaning a simple moving average applied on the relative strength index and can be used for entries and exits in the market. The yellow line is what we refer as the overall market sentiment. It's the middle Bollinger Band, and it shows the overall direction of the market. The overall market has a tendency to do 2 things. It can turn slowly, or it can continue to go in the initial direction. This is because the moving average, usually of 50 period, is less responsive to quick market changes and turns slowly. Last but not least, we have 2 blue lines, one above and one below. Those blue lines represent the volatility in the market, representing the upper and the lower Bollinger Bands. They are increasing and decreasing in volatility. Regarding the calculation procedure, you have several lookback periods you must tweak and adjust. The most important thing you must keep in mind is the fact that the TDI indicator is based on the RSI. All lines of the indicator are calculated on the information of the main RSI oscillator. RSI forms the overall graphic picture because the main task is to assess the rate of change in the price. A shorter RSI period below 10 will be volatile and will have a lower level of reliability. A longer RSI period above 20 smooths out the plotted line and will generate signals that are more accurate. I personally would not use a lookback period below 20 on the RSI. You can also change the period of the moving average applied to the RSI. I don't like using fast moving averages below 10, so I would backtest moving averages with 12 or 21 lookback periods. The Bollinger Bands period must not be lower than the moving average period. If you choose a period of 20, for example, for the moving average, and 20 for Bollinger Bands, the 2 lines will become 1. I prefer to apply a 50 period on the Bollinger Bands, and in some cases, even a period of 100. So how to trade with Trader's Dynamic Index, and what are the main signals offered by the TDI indicator? The first signal, the crossover of the green and red lines. The short-term trend is determined by the relative arrangement of the green line in relation to the red line. The trend is considered ascending when the green line representing the RSI moves above the red line, the moving average. If the green line is below the red line, the market is considered bearish. This is practically an entry trigger. If the green line crosses the signal red line from below, it's a signal to buy. If it crosses the red line from above, this is a signal to sell. You place the stop loss behind the nearest swing high or low, and you take the profit at the channel bands, the blue lines, or after an inversed crossing of the green and red lines. Now, very important, a crossover of the RSI with the moving average isn't necessarily an invitation to enter a trade. In some instances, if the price trend isn't strong, you can have multiple crossovers in a short period of time, offering many false signals. Before acting on the crossover of the green and red lines, examine price action and make sure you identified all major support and resistance points on your chart and take the signals from these key areas. This is very important. Take TDI signals from major key levels on your chart. Here are several examples of valid trades. Second signal involves the crossovers between the red and yellow lines. The yellow line, the middle Bollinger Band, indicates a long-term trend, and most of the trading time moves in the range between the levels of 30 and 70, with the exception of speculative moments. This line will define key turns for a change in the trend. If the yellow line crosses the 30 level downwards, a new swing low could form in the market. A breakaway of the 30 level upwards signals a potential reversal or the beginning of an ascending correction. If the yellow line rises above 70, a new swing high could form in the market. A breakaway of this level downwards signals the beginning of a descending correction. The global trend is defined by analyzing the arrangement of the yellow and red lines. When the yellow line is pointing down and the red line is below it, the trend is considered bearish. For a bullish market, you need a mirror image. The yellow line turns up and the red line moves above it. Again, you don't take crossover signals blindly, you take them after you identify the key levels in the market. Here are other examples of valid crossover trades. Another signal is the crossing of the 50 level by the yellow line. This trading signal emerges when the middle Bollinger Band crosses the 50 level of the RSI. This is a long-term trading signal, especially if it appears on longer timeframes. If the yellow line crosses the center line from below, this is a signal to buy. If it crosses the level from above, it's a signal to sell. To make the signal more powerful, use it in combination with breakouts of support and resistance levels, or trend lines, or with the formation of new price patterns. While many traders focus on the fast-moving average, the red line, I prefer to pay extra attention to the yellow line to smooth out the noise of shorter-term price fluctuations. The slope of the yellow line is also important, as it indicates the strength of the market trends. When it points upwards, the market sentiment is bullish, and when it points downwards, the sentiment is bearish. The fourth signal is related to trend strength and the range of volatility. The TDI indicator also signals the current market strength. We can analyze the relative location of the blue Bollinger Bands and the RSI line. If the channel bands diverge or expand, and the green line forms a strong direction up or down, then there is an active volatility on the market, and the probability of strong directional movements or a continuation of the current trend is high. The greater the angle of the green line, the stronger the players in that direction. If the channel lines converge or become narrow and the RSI line shows short movements, the market is ranging or is preparing for this state. The closer the green line to the center line, the 50 level, the less the market is active. So the expansion of the Bollinger Bands signals an increase in volatility. The narrowing of the lines, on the contrary, indicates a decrease in volatility and a weakening market. The fifth signal involves TDI regular divergences. Many traders concentrate on crossovers, but they neglect an important signal coming from the TDI, divergences. Occasionally, price makes a new higher high, and TDI fails to do so. The new high on the TDI is lower than the previous high. Conversely, sometimes price makes new lower lows, but the TDI doesn't get below its previous low. These situations are called TDI divergences. There is a divergence or a mismatch between the information we get from the price, because the market continues its trend and makes new extreme, and the RSI line of the TDI indicator. The market fails to break through the previous extreme, and the trend may be changing soon. A high probability signal would be a crossover between the RSI line and the moving average after you spot a divergence. Of course, this must occur at an important level of support or resistance. Here are several examples of TDI divergence trades. If you got any value from this and learned something new, leave us a like to show your support, subscribe to our channel and click the bell icon to stay in touch with new uploads. Until next time.